Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. Stocks closed near all-time highs last week, and that may just be the beginning. While historical data shows stocks up an average of just 6% in the year after the first rate cut by the Fed, a wave of cash is heading for the stock market that could boost equities even higher. I'll detail the $2.5 trillion coming into the market over the next year, along with important news on shares of Supermicro, CrowdStrike, and Costco. But first, I will show you the stocks that could benefit on that wave of cash. But if you ever wanted to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You'll see the first stock immediately, and then they're going to email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link below. Back to our main topic, and that Fed rate cut last week is about to send a wave of cash looking for yielding investments, and it's likely to find its way into stocks. Analysis of FDIC data shows that by October, $950 billion in term deposits, so those certificates of deposit, those CDs at a bank, will be maturing and need to be reinvested. Looking further out, that wave grows to over $2.5 trillion over the next year. Now, investors are going to have a choice to roll that money over into a new CD, but at much lower rates, or invest the money. For example, S&P data shows the published rates banks are offering, with more than 2,000 banks, more than 1 in 3 offering no more than 3% on new CDs. And remember, these rates are nominal, so minus out that 2.5% inflation, and even a 4% CD is really only paying you 1.5% in real terms. And as the Federal Reserve cuts further, it's going to affect not just these rates offered by the banks, but also trillions of dollars in other cash-like investments. I pointed out last month the $6.3 trillion sitting in money market funds, up more than $3 trillion just since the pandemic, along with almost $4 trillion sitting in checking accounts, earning next to nothing. We know that homeowners love to use the equity in their home as a piggy bank. Homeowner equity has surged to $31 trillion, up nearly $12 trillion over the last 4 years as home prices soared. That is almost half the size of the U.S. economy in paper wealth, but homeowners haven't been able to tap it because of those high interest rates over the last couple of years. The value of home equity lines of credit, or HELOC loans that people take on the equity in their home, has plunged from $340 billion to under $260 billion recently. So homeowners are actually $12 trillion richer in home equity, but haven't tapped any of it because mortgage rates have been at decade highs. But last week's 0.5% cut by the Fed shows the central bank is ready to aggressively bring down rates. The Fed's dot plot survey of participants shows most FOMC members see another 0.5% in cuts between the last 2 meetings of this year, and another full % of cuts next year. That could mean rates between 2 and 2.5% lower over the next year, having the prior Fed funds rate and just destroying the yield on those related products like CDs and money market accounts. All this means a tsunami of investable cash coming for stocks and bonds over the next year, not just from the trillions maturing in CDs, but also money markets and potentially that $10 trillion plus as homeowners start tapping their homes for cash again. Now, of course, you don't liquidate a guaranteed CD and turn around and bet it all on the hot stock of the day. So I think much of this money is going to flow into bond funds and some of the safer stock sectors or even dividend stocks. Bond funds like the iShares US Aggregate ETF, ticker AGG, would be a natural choice with its 3.4% yield and more than half the bond holding in US Treasuries and those government-sponsored organizations. It's returned 4% annually over the last decade, but as interest rates fall and bond values increase, I think a lot of investors see that share price increase and allocate more of their money toward these bonds for that yield plus upside. Now, another bond fund that could benefit is the iShares Investment Grade Corporate ETF, the ticker LQD, which is only a little riskier, holding bonds of high-quality companies like JP Morgan, United Health, and Oracle. Since these are longer-term bonds in the fund, values should rise faster as those interest rates fall, so you're likely to see a higher price upside on top of that 4.2% dividend yield. Consumer staples is a relatively safe group in stocks that could also see some of that CD money. The Consumer Staples Sector ETF, ticker XLP, holds shares of the largest 38 companies in the United States in industries selling things that we have to buy, like beverages, food, and household products, so cash flows are pretty consistent here. CD investors giving up that 5% yield are going to want that continued cash flow, so dividend stocks should also do well, including one of my favorites, the Schwab US Dividend ETF, ticker SCHD, with its 3.3% dividend and 19% price return over the past year. Looking out at the stocks I'm watching for this week, Zscaler, ticker ZS, and CrowdStrike, CRWD, could have just created a dominant force in my favorite investing theme right now, cybersecurity. The two are launching a new set of AI and zero trust integrations into CrowdStrike's Falcon software to coordinate threat sharing, detection, and response. Zscaler's Zero Trust Exchange and CrowdStrike's Falcon software are each company's competitive advantage in the industry, and combining them, I don't think there's another company that can beat that. Of course, CrowdStrike is still down from the major outage in July, and we're going to have to wait for its earnings in late November for all the damage on that, but I analyzed cybersecurity stocks recently in a video and found these two are the least expensive in terms of price to revenue to growth, both expected to grow sales by 20% plus over the next year. Now I've got 300 shares of CrowdStrike at $277 a share and 300 Zscaler at $173 per share, buying both after that recent price weakness. Super Microcomputers, ticker SMCI, is another one I picked up recently on that dip, buying 200 shares after the data center hardware company got hit by a short seller report. I'm preparing a full video for Wednesday, but Hindenburg Research is accusing the company of a list of issues, including that sales staff fired after the 2020 fraud case have been rehired, along with accounting practices that inflate growth, related party transactions, and a weakening margin trend. I'm going to leave the details for Wednesday's video, but none of these are make or break moments for the company. In fact, it really just appears nitpicking to me, a way for Hindenburg to make a fast buck on one of its short stocks. SMCI is a leader in data center hardware, using NVIDIA chips to power its server racks, and right in the middle of that booming growth that's just getting started. We found out just recently that Microsoft and BlackRock are launching a $100 billion fund to build out data centers for AI. Utility provider Constellation Energy jumped 21% on Friday on news that it would be supplying electricity to Microsoft data centers from a restarted nuclear plant. So they have the electricity. The only question is all that hardware that goes inside, and SMCI is going to get a chunk of that. Costco Wholesale, ticker COST, is going to be a very important read on the health of the consumer when it reports earnings on Thursday. Both Dollar General and Dollar Tree plunged on their reports, while Walmart and Target jumped, as it seems those two larger retailers are really consolidating that market share as consumers pull back. Costco is expecting to post a 5% sales growth this year. That would be against forecasts of negative 0.6% at Target, revenue growth of 14% at Walmart, so clearly Walmart is picking up industry sales at the expense of others here. Costco earnings are expected up 15% this year versus 6.8% higher at Target and 20% growth at Walmart, so they're keeping closer to Walmart's leadership in that respect. Surprisingly here though, shares of Costco are the more expensive at a PE of 55 times and almost 1.6 times price to sales. That's well over the PE ratio of 16 times and 0.68 times sales on Target, and even over the PE of 40 times and 0.95 times price to sales for Walmart. So I would go with Walmart here for that growth, but maybe look at Target for valuation. Costco has managed to keep up, with shares higher by 36% this year, well above the 10% return on Target, but underperforming that 50% return on shares of Walmart. Giving you the big picture here with the Sector Spiders Sector Tracker, 8 of the 11 stock sectors finished higher last week, with energy stocks really leading on that second week of higher oil prices and financials benefiting from the start of the Fed rate cuts. The three laggards of the week, consumer staples, healthcare, and real estate, really seem to be more of a give back from strong performance over the last month rather than any fundamental weakness in the stocks of these sectors. Technology stocks were the notable losers last week and really recently over the last few months. With major indexes at all-time highs, you would think growth stocks in tech would be outperforming, but that hasn't been the case. Stocks in the tech sector have now underperformed the market in every time period up to year to date and are down 2.7% over the last 3 months versus a market that's up 4% in that period. It should help bring valuations down a little bit in the sector, and as long as that weakness doesn't spread to these other sector stocks, then the overall market should remain healthy. Get your free report and see the stocks I'm buying for the next 30 years, my forever stocks, only with the link in the description below. Or click on the video to the right to see the 10 stocks I just bought with over $500,000. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.